The SEC has just approved the first ever Bitcoin ETF. This is huge news and it's going to have a big impact on the price of Bitcoin. But here's how it works and why the price didn't immediately explode higher. So this ETF is called the Spark Bitcoin Strategy ETF, and it's only available to accredited investors. This means that the average retail investor cannot invest in this ETF. Only institutions can. And this is by design. The way it works is that these institutions will pool their money together to buy shares in this ETF. And then the ETF will use that money to buy Bitcoin and other cryptocurrency assets. So it's like a basket of crypto assets. Now, because this is a new investment vehicle, it's limited to accredited investors only. But in the future, they may open it up to retail investors as well. And this could bring in a lot more money to the crypto market. But here's the thing. The SEC has not yet approved a spot Bitcoin ETF. This is a big difference. And it's important to know the difference between a spot Bitcoin ETF and a Bitcoin futures ETF. A spot Bitcoin ETF would track the price of Bitcoin over time. So you would buy shares in the ETF, and then you would sell those shares for a profit if the price of Bitcoin goes up. A Bitcoin futures ETF, on the other hand, is a little more complicated. A Bitcoin futures ETF is a basket of Bitcoin futures contracts. So when you buy shares in this ETF, you are buying a small piece of those futures contracts. If the price of Bitcoin goes up, then the value of those futures contracts will also go up, and this will increase the value of your investment. But if the price of Bitcoin goes down, then the value of your investment will also go down. So basically, a Bitcoin futures ETF is a way to bet on the price of Bitcoin without actually owning any Bitcoin. So now you know how the first ever Bitcoin ETF works. But do you know how to protect yourself from the risks of investing in Bitcoin? Stay tuned to find out more.